Most of us think of our Employee Provident Fund, our EPF, as this totally tax-free vault for our retirement savings. But what if I told you there are a few cracks in that vault? Today, we're going to talk about the 4 specific times when your EPF money actually becomes taxable. So, let's just get right to it. Is your EPF really, truly 100% tax-free? I mean, we've all heard that it's the ultimate tax-saving plan, right? But the reality is, there are some pretty important details in the fine print that every single person earning a salary needs to know about. The whole idea comes from this thing called EEE status. It stands for Exempt-Exempt-Exempt. And what that's supposed to mean is that the money you put in is exempt, the interest it earns is exempt, and the money you take out is exempt. Sounds like a perfect deal, doesn't it?
Well, here's the twist. While that EEE rule is generally true, it's not a blanket guarantee. There are 4 key situations where that tax-free shield just doesn't apply. And that's exactly what we're going to dive into right now.
Okay, first step, let's talk about the money going into your account. You heard that right. Even the contributions you make can in some cases end up triggering a tax bill. Now, this is actually a 2-parter. There's one rule for the money you put in and a totally separate rule for the money your employer puts in. Let's tackle your contribution first. Okay, remember this number, 2,50,000 rupees. This is the magic number for your own annual contributions. You're definitely going to want to keep this one in mind. So here's the deal. If your personal contributions, and that includes your regular EPF plus any extra you put into a voluntary provident fund or VPF, go over 2.5 lakh rupees in one financial year, it's the interest you earn on the amount above that limit that gets taxed. So not the contribution itself, but the earnings on it. It's a subtle but really important distinction.
All right, now let's flip over to your employer's side of things. The number to watch here is a lot bigger, 7,50,000 rupees.
So, this rule looks at the total amount your employer contributes to your retirement bucket. That's your EPF, your national pension system, and any superannuation fund, all combined. If that total goes above 7.5 lakh in a year, the extra amount is treated like a perk, a perquisite, and gets added to your salary and taxed. And here's the kicker, the double whammy. Not only is that extra contribution taxed, but any interest it earns is also taxable.
Okay, on to our second big scenario. This one is all about timing. Specifically, it's about what happens when you take your money out too soon.
Now, this is a huge one, so listen up. If you withdraw your EPF money before you've completed 5 years of continuous service, the entire amount you pull out could suddenly become taxable. That 5-year mark is absolutely crucial. So what actually happens? Let's break it down. First, the portion you contributed becomes taxable if you claimed an ADC tax break on it in the past. Second, your employer's share and all the interest it's earned get added to your income and taxed as salary. And finally, if the amount is over 50,000 rupees, they'll automatically cut 10% for tax deducted at source or TDS. But, and this is a really big but, there are some key exceptions. This tax rule doesn't kick in if you lost your job for reasons that were out of your hands, like the company shut down, you got laid off, or you had to quit because of a major health issue. In those cases, your withdrawal stays tax-free. All right, let's talk about our third scenario. Now, this is a trap that a lot of people fall into after they've retired or left their jobs, and they often have no idea it's even happening. Okay, so think about it like this. While you're working, any interest your EPF account earns is tax-free. Awesome. But the moment you stop working, whether you retire or just change jobs, if you just leave that money sitting in your EPF account, any new interest it earns from that point on is fully taxable. The account essentially becomes inactive, and the tax exemption on the interest just vanishes. So we've gone through all these different rules. What does it all really boil down to for you and your savings? Let's pull everything together into one simple checklist that you can use. Let's do a quick-fire recap. 1. If you put in more than 2.5 lakh in a year, the interest on the extra amount is taxed. 2. If your employer's total retirement contributions go over 7.5 lakh, that extra chunk and its interest get taxed. 3. If you pull your money out before hitting the 5-year mark, the whole thing can become taxable, but there are exceptions. And 4. If you leave your money in the account after you've stopped working, any new interest it earns is taxable. So there you have it. The EPF is still an absolutely fantastic savings tool, no doubt about it. But that completely tax-free label, it definitely comes with a few conditions. Knowing what they are is just key to managing your money the right way.
And that kind of leaves me with one last question for you. Which one of these tax rules was a total surprise to you?